Okay, so thank you very much, David, for inviting me to today's Fiborama, I guess we should call it. And what I'm going to talk about here today is retracement setups and strategies for a volatile market. And we have a very volatile market for the past couple of months and probably going to be that way for some time here. So what I always like to be visual about things. This is the way that I learn. This is the way that I like to communicate. So what we're going to be doing is following the bouncing ball from the lower left up to the upper right as I go through these. So you can kind of get, for you watching at home, you can kind of get an idea for, where we are and what we're going through here today. So I always like to start up by defining what the problem is. So what is the problem that we need to fix? Accurate charting and price discovery leading to directional trading edge. So the problem here is that our own embedded human nature, we are just a bunch of chimps that we all start the wrong way. So we start with analysis in the same manner that everybody else does. We are herd animals. And one of my favorite things to do is to join 100,000 of my closest friends on a football game on Saturday or Sunday, and we're all cheering for the same team, and it feels great because, we all win as a team and, hopefully, and that feels great, but that doesn't work out too well when it goes to trading. So it's in our nature to go with the crowd. No one wants to feel like they missed out. And we're also used to social logic too. What do you guys do when you go on to Amazon? The first thing you do is you look at, well, I don't want to buy something that's only got 2 stars. Obviously, that's no good. So right off the bat, we're implicitly trusting everybody else to make our decision for us, whether it's Bacon Bros or buying some kind of a sword machete off of Amazon. We have socialized our decision-making process. For the better part of a generation, we're used to it now. It has become common. So we do the same thing with investing. We say, well, if it works with buying a katana or determining how good a restaurant is, surely it would be good for investing too. Who wants to do this on their own? So people join Discords, they find different kinds of subreddits, forums, whatever, and this is what is social investing. And we think that this is the safest thing to do is, obviously through the strength of the crowd. But the problem is that doesn't work very well. We become part of the chum that's thrown out there for the sharks. And we're always chasing the price of an asset. Somehow somebody gets in front of us. We're buying at the highs and selling at the lows. This is never going to work for us. And so we say, well, let's go to more traditional media. And even going to something like a CNBC or the Wall Street Journal or any of these other resources out there is not necessarily the way to go. Famously, Bill Ackman came on during the height of the pandemic. Well, actually, right before the pandemic got really, really ugly and said, yeah, we need a 30-day shutdown. We need to shut down our whole economy for 30 days and get rid of this thing. And the market just absolutely panicked and circuit breakers fired. Of course, he was short through the whole thing and he covered right after that, which he defends to this day, but CNBC was a vehicle that he used to accomplish his goals. And so I don't think it's still very fair. People will get on there and talk their book. And so I don't trust the investing media. In fact, I don't want to hear anything from it. So ultimately, we're looking for guidance. We know that we need help to get away from the rabble, but the search can be very difficult to find somebody that aligns with your belief system. Feels like everybody's out to take advantage of you. Feels like this whole thing is just rigged against the retail trader. This is how we start. Now, eventually, if you stick with it long enough, you'll find your way. After many serial disappointments, I certainly had my own. Those that make it finally figured out that we need to adopt our own plan. First of all, we know what we're trading. We've stopped trying to be a jack of all trades and a master of none. You finally know what you trade and why you trade it. We have a plan. And you're treating this like a business. Failure is not an option for those of you that need to trade to put money or to put food on the table. Price discovery. for the pros used to be right in front of their face. Literally the sights and sounds, and in some cases, even the smells of price discovery led people to have an edge, those that were on the floor. And they were literally the reason why markets moved. But unfortunately, a lot of those people have gone off the floor, they've gone upstairs, and solitary price analysis. It's just you and the chart. We all feel this same way. This is the way I felt for the past 20 years. So we all have to find our way and get our own plan. So a lot of us think that this is why I like today's topic, because it's about something that's very near and dear to me. We all start by thinking that more is better. So we all start with a price chart that's out there and we say, well, that looks good, but I don't know where it's going. So I need something on here to let me know where it's going, or at least that's what we think when we first start out. So we say, well, let's add some moving averages. Everybody talks about the 50 and the 200 moving averages. That will allow me to understand when we have a death cross and a golden cross and et cetera, things like that. But that still isn't enough. You figure, you know what? I saw these things called the MACD, and everybody uses the MACD. So we're going to add the MACD lines and the histograms on here, and I'm going to feel much better about where things are going. We can see momentum that's hanging on here. And of course, everybody talks about stochastics. And so we're going to put an oscillator on here and understand stochastics and oversold and overbought and things like that. And still, that's not enough. So we add the RSI, the relative strength index, because everybody says, well, if you don't follow the RSI, then how much of a trader are you? So we add that, and that still doesn't seem to be helping us. So we say, you know what? We need Bollinger Bands. We need to understand the volatility that's on here from a moving average plus and minus 2 standard deviations. And these act like the ropes of a boxing ring to let us know when things have gone too far too fast. But that still isn't enough. So we add the Keltners, and we try to create what's called the squeeze indicator from this. Okay, so we're getting there, but still not making money at this. So we see this cool thing called the Arun oscillator. Well, that's got to be easy to follow. So it's easy to follow, but we don't necessarily make any money from it. So we're adding the ADX so we can follow the strength of the trend and still, I mean, you can see where this goes here. The problem is that we have now constrained the one thing on the chart that really gives us the most information, which is the price. The price. And instead, we've added all this junk that's down here, which doesn't necessarily give us any additional edge. These are all trailing indicators. So more is not necessarily better for this. So is there a simpler way to do this? You've twisted yourself into a pretzel with indecision. You end up trading not to lose instead of trading to win. And this is why I think all of us need to simplify our approach to see the answer. And so what I would say is give price a chance. Hopefully you can see what I did there. Like everyone else, I was overwhelmed by market movement when I first began. I bounced from one time frame to another, one technique to another, never achieving consistency. So over the years, I've realized you can't beat following the actual price chart. In fact, today, if you just gave me a price chart, maybe a couple of different time frames, that's all I would really need. I really don't need anything else. Although we will talk about how to use price in different manners today. There's no delay, no latency, nothing to interpret but raw price discovery. So all we need to do is to add a little structure to it in order to be accurate. That's my belief. So that's the problem that we need to fix. That's what I'm going to be talking about today. So here's some basic rules of price. Okay, so bear with me. If you're an expert on this stuff, bear with me for a minute. We'll get past this. There's just a few basic terms that we need to agree on. First of all, price has structure. A newer trader is going to look at this price chart and say, well, this is all just squiggly stuff, and there's more squiggly stuff which is going down, and here's squiggly stuff going up. And they're not going to really see between the lines. They're not going to see what's actually happening here, that there's a very well-ordered structure behind how price moves, similar to how traffic moves on a freeway. Really, it's very ordered and very structured. So we have what are called impulsive moves. Impulsive moves are ones where we just, we're moving in a specific direction Typically, we call these uptrends, right? You can have impulsive moves to the downside, but typically with positive drift, we're going to have most of our impulse waves to the upside. Okay, so what is the overall trend of this price action? It is to the upside. It goes from the lower left up to the upper right. So we're going to call these impulsive moves, the ones that we had in from the bottom in 2020 all the way up to the top at the end of 2021. And then we have some other impulsive moves where we started moving into the next cyclical bull back here in 2023 to where we are today. So a price move in that direction is considered impulsive. And then conversely, we have corrective moves, which go opposite to the impulsive move. So these are called corrective waves. Okay, so hopefully with me so far, impulsive, corrective. I'm not an Elliottician, but these are the same terminology. This is the same terminology that they typically use in the Elliott wave bunch. Okay, so what I would suggest is that it's balanced. The price action is balanced. We have moves up, we have moves down. The thing here is that we don't have, even though it seems like it sometimes, we don't have moves that go forever and ever and ever, and we have infinite slope to the upside, and it just goes from 0 up to 10 million. That just doesn't happen, right? There's always some balance to it. For every action, there's an equal and opposite reaction with a little bit of a positive drift thrown in over time to keep things sort of going from the lower left to the upper right. So we have these things called price swings. Now, what I've done is I put the zigzag study on the chart and set it for some kind of random number just to show you that. And I used to use this when I was intraday trading futures. We would put zigzags on here, and this is all that we looked at is really just the highs and the lows of the zigzag. So if somebody says to you that an uptrend is a series of higher highs and higher lows and higher highs and higher lows and higher highs and higher lows, now you know what they're talking about. These are the highs and the lows. And sometimes if you can't see these, this is what you will see. Okay. So those are price swings. Now the trend polarity is when you have a change in polarity. This is where here's an uptrend, higher highs and higher lows. All of a sudden we have a change in polarity to lower highs and lower lows. Okay, and so we have lower highs, lower lows along here. And then we have a change in polarity back to an uptrend with higher highs and higher lows. This is what we care about, these big changes in polarity when they happen. This is where the maximum reward to risk is found, the maximum opportunity. It also comes with the maximum confusion because most people are leaning to the upside when things start to move to the downside. So it's balanced. We have trend polarity. We have reversals, change in polarity on the reversals. And there we go. That's Dow theory from 1939. So let's summarize price here. So I'll do this quickly. For those of you that are in the know, we have impulsive waves that go in the direction of the general trend. We have corrective waves that go counter to that trend. Price discovery in the auction process creates a balance. So this is always good. I'm always a big believer in free markets because they will always find a balance. Go read Adam Smith. Price will not go in one direction forever. It creates an imbalance. When the price goes too far in one direction, the market will correct eventually, even though it doesn't seem like it will ever do that sometimes. Of course, the Dow theory definition, an uptrend is a series of price swings that create higher highs and higher lows. A downtrend is a series of price swings that create lower highs and lower lows. A change in polarity marks a transition from like an uptrend into a downtrend or a downtrend back up to an uptrend. Positive drift exists in most markets due to fundamental reasons. We don't need to go into those now. So how can we use these concepts to create trading opportunities? What else can we do with this? That's the basic rules of price. You could trade with just that alone. Well, the biggest way or the most common way to do this is to buy the rips and sell the dips. This is the time-tested approach to trading. So first of all, we never want to be chasing after the market. And it's a very real problem because of the psychology. Remember, we're herd animals. We want to be included. We don't want to be left behind. This creates panic in most people when we see a market ripping to the upside. Wait a minute. Wait for me. Don't leave without me. Actually, do you realize that a market running away without you on board creates more stress and anxiety to the human mind than does taking a stop out on a losing trade? You take a stop out on a losing trade, you're like, well, darn. But the agony that you go through sitting on the sideline watching a market run away without you is unparalleled for the amount of pain that it creates. So we talk about fear of missing out. To me, the market moves based on fear, not on greed, but fear alone, fear of missing out or fear of loss. Fear is the biggest driver in the markets. So we don't want to be chasing after the markets. What we want to do instead is we want to buy the dip. Everybody says just buy the dip, BTFD. Buying after a dip or pullback in price creates better opportunity at a lower price point with better reward to risk properties, right? We all know that, but it's a different deal when all of a sudden you're looking at the hard right edge saying, wait a minute, this thing is trending down. Why should I be buying here? So that's something that we all have to learn to live through. But problem is we don't know where. Also, if we flip things around, the market's ripping to the downside, it's selling off. We don't want to be chasing lows either. We've got the same problem to the downside. And sometimes it can be even harder because the rallies that come from bear market rallies are the strongest ones ever. They're always much stronger because of the short covering aspect of it. So what we want to do instead is, instead of buying the dips like we were over here, right? We were buying the dips over here. We want to sell the rips. We want to get short or set up short delta trades at the relative highs in the context of a bear market. Again, higher price point, better reward to risk properties. But where? Where exactly should you look for a pullback or bounce entry if we're going to buy the dips or sell the rips? Well, this is where fibs come to play. Fibs can help us here. We can use Fibonacci retracements to help us locate a potential buy or sell point. Now, I'm not going to go into the theory of Fibonacci retracements. I'm sure somebody today or this week will go into great detail on exactly why these things work in the way that they are. To some degree, they become a self-fulfilling prophecy because they have become popular and people do use these. They do put these on their charts and they do make decisions at these levels, which is where everyone can see. So what I found is that that doesn't necessarily work against us just because we're become a little bit more sophisticated than most investors. So we can use these Fibonacci retracements to help us locate a potential buy or sell point, and then use a buy or sell trigger to initiate the trade. We'll talk more about that in a minute. Boy, what a round trip today, huh? Okay, so we want to buy the dips, sell the rips, and we're going to use fibs to understand where to buy the dips and potentially sell the rips. We're going to use it as one of the tools that we're going to do for them. So let's get into fib retracements for a minute. These are part of my bread and butter price analysis techniques. So again, nobody's talked about any kind of studies or 14-period fancy indicators, anything like these. Are standard fib retracements. So fib retracements, again, if we are looking at a primary impulse swing, and we're going to go from 0 up to 100% in this case. So this is where it begins. This is where it ends. And what we're going to find is that we're going to have 23.6, 38.2, 50%. We're going to have all these different numbered percentages of retracements. And if you actually calculated this, you would see that 50% is going to equate to exactly 50% of the vertical displacement of price for this. So 50% retracement means that the swing goes up and then it eats 50% of the entire rally on the retracement or the corrective move. So these are fib retracements. Very simple. Now, the standard numbers that we're going to use, again, I'm not going to go into fib numbers here at all. I'm not going to go into fib numbers. I'm just going to talk about percentages. And so these are based on the golden ratio and things like that, but we're going to use mostly these three in the middle right there. 38.2, 50%, 61.8. We're going to use those percentages quite often. Okay, so you can read more about the golden ratio if you're interested, because it shows where this all came from. You know, there's some things that'll make you smart, and there's some other things that'll make you money. I'm just going to talk about the stuff that'll make you money. So those are fib numbers. So the important ones here that we're going to focus on, 23.6, 38.2, 50%, 61.8. So again, just in the context for this visually, let's imagine an upswing. We have an upswing that goes from 0 to 100%. And then we're going to pull back some percentage of that, whether it's 23.6 or 38.2 or 50% or 61.8. So the 23.6, this is a very minor pullback. So when we get up to a 23 or pulled down to a 23.6, a minor pullback, I don't find this to be all that valuable, because most of the time, the 23.6, if we bounce from here, a lot of times this will lead to a lower high, and then we end up coming back down anyway to one of these three major fibs, which is the 38.2, 50%, and then 61.8. So bear with me on the numbers here. So the 23.6 I don't find to be all that useful as a direct level that we can buy from or sell against, whatever. But 38.2, oh yeah, this is the first real pullback. This is a real barometer for how strong the overall trend still is. So if we have a strong trend which goes ripping up and then pulls down to a 38.2 and finds support there and bounces, that's going to be a great signal. That's going to be really nice. Now, some of them go deeper than that. We've seen recently in the S&P, we've had a full 50% pullback, literally to the tick. I think it was last Friday or Monday. I forget which day it was. To the tick, 61.8. Now we're getting interesting, because when we pull back to 61.8, now this is the last line of defense for the bulls. This is the moment of truth. If this does not hold, this has to bounce from here. If this does not hold, typically then we fill in the entire triangle all the way down here. So this is, you're peering over the edge at this point. And so for the most part, now you're always going to find exceptions, but for the most part, if you undercut 61.8, you're going to fill in the triangle. Very, very few times do we actually go lower than that, than actually recover. And there's no guarantee that even if you get down to 61.8, that you're not going to recover to a lower high, roll over again. But those are the four important numbers, and of those, the bottom three are the most important to me. Now, something I have to say here, fibs are not an entry signal. Don't use fibs as an entry signal. So what I mean by this is, all right, let's say the price swings up, comes down to a 38.2, and you can't wait, right? So you've sat on the sideline waiting for your pullback for weeks, and finally it pulls back and you can't wait. So there's the 38.2, you put a buy order in, you put a limit order in, comes down, hits your limit, boom, you're in. And then it keeps on going. So there's no intelligence to a fib level that says, yep, that's where support is. It's just a level, and it's meant to be used in conjunction with other signals in confluence. So what you're looking for is evidence that it's actually bouncing from this level. You want to see evidence that it actually does find support, that there is a buy wall down here, that there is a lot of demand down in this level. Okay. So we don't know that just from the fibs. We have no idea. So it's kind of a catch the falling knife trade if you're just going to trade off the fib levels, which I don't think you should do. Okay, so that's what fib retracements are. Now let's get into using them. Okay, so we're following the bouncing ball. Here we go. We have to know what problem that we need to solve. So what is the problem here? So when the price is in an uptrend, you're going to have pullbacks or corrective waves, right? So this is our impulse. We have a corrective wave, impulse, and it looks like we may be starting a corrective wave at this point. Looks like we have a lower high, lower low. It looks like it's rolling over. So it's going to pull back somewhere down here. We don't know where. We have no idea where. And we're smart enough to know that we can't predict the future. We don't know what's going to happen in the next 5 minutes, let alone 5 weeks from now. So what price levels can we map out ahead of time to see if we're going to have a positive reaction and potential support? Again, we're just doing potential support. We're just getting ready. We're getting ready to get ready to get ready to buy. But we're not just going to stick our limit order in there and say, if it comes down to 5,200, buy. Because what is low can go lower. We don't know if that's the highs and it's going to go down to 4,600. And then guess what? We're a bag holder now. That's no fun. So that's the problem that we have to solve. So step one, we've identified at this point that this is an impulse swing and this is done. It is done. It has started to reverse. It's now making, at a smaller time frame, it's making lower highs and lower lows. If we were to go down to something 5 times faster than the daily chart, like a 78-minute chart on the SPX, we would see a very well-defined lower high, lower low reversal right there. So it's done. This impulse wave has finished. Now what we're going to figure out is, where's the thing going to bounce? Where could it possibly bounce? So we now have important fib retracements identified here at 38.2, which is about 5,200, 5,193, something like that. There's 5,200. 50% is 5,147. And down here at 61.8, representing the last line of defense for the bulls, is about 5,101. We want to anticipate. We're not going to predict. We want to anticipate one of those being our landing spot. So that's kind of the context. We're just framing things in right now. Step two, we need to have some type of a signal to let us know. Now you can use price action for this. You could use smaller time frames as a signal chart. I've got different strategies that use multiple time frames and looks for a 60-minute signal on a 60-minute chart as our signal time frame, and uses the daily chart as an anchor time frame. So we want to trade in the direction of that anchor chart swing, which would be to the upside, but where's the signal to that? So there's lots of different ways to do that. And today I'm not going to have the time to go into like all the different ways that we could do that, but I'm going to share with you a couple of ways that we can. So first of all, just looking at price, if I had no other tools whatsoever, I would say, well, we've got our test of the 38.2 fib. Check. So we'll put a big check mark by that. That's step one. Step two, just based on price action, we've got a hammer candlestick, pretty close to a hammer. Hammers sometimes have a little bit smaller real body, but this thing that's a big lower wick on there. And that's a great big green real body. That's a pretty bullish looking candle. So should we buy at the close of that day? Could be. There's also round number support at 5,200. What you'll find is that on a lot of like individual equities will run from century numbers. So you'll get above 100 and it'll run up to 200. Get above 200, it'll run to 300. This is a Jesse Livermore thing. So read Reminiscences of a Stock Operator, and you'll learn about techniques like that. But they tend to run from these round numbers to another round number. And when it comes to an index like the S&P 500, the round numbers tend to attract attention. They tend to attract attention. Although I would say these days, the actual underlying is the actual S&P 500 futures. So you'll actually see a lot more of these actual round number moves based on the futures and not the cash index. So there's a way that we could take 3 of these price-based trades and we could say we could justify an entry at this point. So we had confluence, we had multiple signals stacking up here that said, go ahead and buy. Okay, so that's one way we could do it. Now we could use other studies. So we could use what it's called fractal energy, which some of you may have heard of before, where we're looking for multiple time frames to create a signal. So we have monthly chart, we have a big swing here. Weekly chart, we have a big swing going on. Daily chart, we have a pullback, and we're looking to just join these parent time frames. So at the weekly and the monthly chart, right, all we're doing is we're just aligning the trend. All that momentum, we're just going in the alignment of that. And we have a lot of energy here on the daily chart. So this was a good signal that it was fully charged up, receptive to trend continuation. Okay, so we could use fractal energy for that, or we could use a cool little indicator called the RSI Laguerre. The RSI in Laguerre time. So this is not a linear time basis. This is based on the Laguerre time transform. So what we're going to look for is this blue line to hook up out of the oversold area. And this is similar to a relative strength, but it is much more responsive than the standard Wells-Wilder indicator. So this is a custom study that we use for single signal entries, which is more responsive to things like SMI or stochastics or Wilder RSI. So this hooks up, and that gives us our confirmation, boom, go. And we can actually even email ourselves when this does fire. So that is called an RSI Laguerre hook signal. And that's long. Now we could also do shorts. Shorts the same way. So here we have our 2022 bear market, where we're making lower highs and lower lows. And so what we're looking for here is we're looking for a pullback entry. We want to get short on this dude. And so we've come up to a 38.2 retracement, bang, 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 tried to get through there, unable to. We had a brick wall of overhead supply at the 38.2% retracement. Okay, so that's a short entry for this. Now, something else that we could do is fib confluence, where we can use fibs from basically different swings or different time frames. So here's one where we're taking one from this entire mega swing here, the entire thing. And we're going to set up retracements on that, like 23.6 and 38.2 and so forth, right? So we're up here, and what we're looking for is where's this thing going to find support? And then we're going to write a shorter term. We're going to put fibs on a shorter term swing. And what we're going to look for is where did they line up? Where do they offer confluence with each other? Now, this one's pretty deep because this actually on the shorter term swing goes down to a 78.6, which we haven't talked about. That is a super deep swing. But notice that basically it did hold, for the most part, the 61.8. So what we're going to do is we're going to try to identify a support level where they line up with each other. So here was one at 50%. right? So that was a 23.6 of long-term and 50% at 5,300. That was support for a little while until it fell through. And then it pulls down to the next support level where you have confluence. But confluence is a really interesting and very valuable technique to use when the price looks like it has no support, right? So when we fall into corrective markets, sometimes it can be very stressful. Yes. You know, you're holding long positions and you're like, where is this thing going to find support? Where's it going to bounce? And so understanding this takes some stress away because you're able to put some things together, and it's very good for that. So again, that's fib retracement confluence. Okay, so this is how I use fib retracements. So what we're going to do is we're going to apply this to a couple of swing trades, or a swing trade here. So we're going to use the fibs in the RSI Laguerre study to a daily chart for swing trade on NVIDIA. So here's the initial chart. We've had this hellacious swing, and these are split adjusted numbers, right? So when this swing trade was actually on, it was in the 800s or whatever the price was back then, back in the late winter, early spring. So mammoth move up here, and here's our pullback. Here's a pullback, okay? And it bounced from the pullback back up to the highs again. But what I'm here to tell you is that taking pullbacks off of 23.6, you can do better than that. In most cases, you'll get the better bounces that really launch the true swings, not off the 23.6, but of 38.2 or deeper than that. So when we look at this, we say, all right, I want to get long, but I don't want to get long off the 23.6. I want to look for a 38.2 or better. Deeper is better to a certain degree. Like I said before, if it pulls down too hard, sometimes the next bounce is a lower high and it keeps on going. So that usually happens when you get on board too late in the party. So that's our initial chart. So now, a few days later, we've got a much better setup. We've had a big bearish engulfing candle that actually pierced the 38.2 retracement. And things are looking dicey at this point, right? So this may have been the after split hangover. I don't recall exactly when they did split, but it was sometime this year. Okay, so we're green light. We're like, okay, let's take a look here. Now, do we have a signal? No, we don't have a signal yet, because what I want to look for is the RSI to hook up here and shows me that we have a long signal. So I'm halfway, I'm like a, there's no yellow light for getting ready, but it's like we're at the starting gates. We're waiting for the signal at this point. So here we are. We have green light. We have green light. We have our signal here, and we are long. Now, you could have also done this through price action. You could say, all right, here's my Darvis box right there. If I see a breakout above 84, I am long. I am long. So that's one way that you could just set up a price entry based off of here, which has got a nice little higher low right there, and then a higher high. So breaking into above 84 creates that long signal, but we're also looking at the RSI Laguerre is doing it for us here. So green light. We are in. Okay, and Yahtzee, this thing worked out really nicely. So this was, of course, I'm going to give you guys an example that shows you something that's going to work out, right? Because we have limited time together. And I want to spur your imagination into something like this is something that you can all do. So using the fibs to set up the context for this, and then using some type of signal, in this case, I'm using the RSI Laguerre as a way to signal me when to get on board this thing. So notice also that we didn't take the bait at the 23.6 retracement. We waited. Even the second bounce here was still no bueno. We waited all the way until the 38.2 retracement. You're going to get a better swing generated from there than you would from 23.6. Okay, so potential strategy here. You could do this with stock. You could do this with long options. However, typically what I like to do is what's called a vertical debit spread. If I want to go long on something, I will go long a vertical debit spread. What this will do is this will fix my risk. So my risk, if I'm wrong, this thing is limited to roughly on a $5 wide spread, it's going to be about $250. My potential reward is going to be about the same, $250. So what I like about this type of trade is the fixed risk nature of it. I don't care if I get gapped through. I don't care if we run into the black swan from hell. I don't care if we have the next pandemic hit and circuit breakers blow to the downside. I'm not going to lose any more than that 250 on that spread. That's okay. No worries. Okay. And similarly, if it does work out for me, I can just set up a limit order to get out at whatever my profit target is. So it's a very low risk, very low maintenance way of doing swing trading where you don't have to worry. And the way that this is built is we don't have to worry about time decay that much. This will hold its value all the way until the very last day of trading. So this is a case where the trade structure allows time to work for you as well, too. So I do like the fixed risk trades that don't require a lot of attention and have limit order exits. Okay, so that's a swing trade that we can do. What else can we do? Let's do an income spread. How can we use fibs for determining where we can set up an income spread? So I want a confirmed uptrend. So my strategy in this case for this example is what's called an income campaign strategy. So this is where I'm selling an option every single day. I'm rolling it, rolling it, rolling it, rolling it, rolling it until I hit my profit target, and then I'm good. Then I book profits and then wait for the next entry. So in this case, I want an uptrend. My cash flow campaign diagonal strategy. So this is where I'm rolling a short option every single day. And it really helps to have an uptrend. It works much, much better with an uptrend. It does not work as well. In fact, I want to avoid a downtrend altogether. There's different ways that I could play it to play that downtrend that works very, very well, but I need to adjust that. So for most of this stuff, we just play the same simple strategy all day, every day. So this is my best performing income strategy. So how can I use fib retracements to help spot the transition back to an uptrend? So I want this to go back up to an uptrend and then I'm green light again. So how can I do that? Well, we're going to add fibs to that downswing. And remember what we said about the 61.8% retracement. This is the last line of defense, in this case, for the bears. If we get the price above this level, it's highly likely to go ahead and fill in the triangle and go straight back up to the highs again. Okay, good. That's what I want. So I am going to wait until I get above that level. This, in this case, is the 54.78. That a change back to an uptrend has likely been accomplished. Now, I'm never going to 100% say for sure, because price can do whatever it wants to. But what we've established here is that if price gets above and beyond, if it closes above and beyond the 61.8% retracement, that there's a very high probability of it hitting the highs, completing the triangle. So we're going to verify that uptrend, and we finally get it. We finally get it right here. Okay, so we actually gap right through that dude. And so we are green light again, green light. And we began the strategy. Which is good because it's fun, right? I like this. So Yahtzee, here's an example of a trade that I just closed out yesterday. So I could close this out before the CPI. But, you know, it's so simple to operate basically because we have a long put, which is basically ensuring the losses against the downside. So this is a self-hedged trade. It's a self-hedged trade. And really what we're doing is we're making our money on the time decay of that short option. that we sell every day. Okay, so this is what we did. We used fibs, waited for that level to say, go ahead, green light, and then back in the trade that we go. So those are income spreads. Okay, so let me give you some final thoughts and get you out to session number 6 here pretty soon. Base the majority of your chart analysis on price action. I can't underestimate or overemphasize that enough, guys. Is that, clean up your charts, learn to read price. Fib retracements are part of the price analysis family, so don't get all snooty and say, well, I want to do well. Fib retracements are part of the price. You can use fib retracements in upswings and downswings. They don't care. Fibs allow you to frame in price levels where you will make decisions. It allows you to kind of narrow in on the context of what you're looking at. So never make decisions on fib levels alone. Remember, we talked about the, catch the falling knife trade. We don't want to do those. We want some level of, I hate to use the word confirmation because I think it's overused, but we want the price to tell us that, yes, indeed, it is bouncing from that level. So pays the most attention to the 38, 50%, 61.8 fib retracements and design entries and exits based on price interacting with these levels. Okay, so those are my final thoughts. Now, what do you do with all this? So it's my belief, if I can editorialize here for just a minute, that I want people to shift to an active income-based focus. So instead of speculating every day, create most of your gains through income based on time spreads, because this market works on time spreads right now. It does not. I used to be Mr. Iron Condor, and those things are a nightmare right now because the price is moving far, far faster than the implied volatility is paying you. So time spreads are working like a champ right now. Trade is a campaign. So don't put them on like for 45 days or something like that. Every day you're rolling out to a new one. And we're using price action to do that. So ditch the old financial income paradigm that no longer works and start to get into something like that. This is what works right now. How can you start to do something like that? I would say consider joining me. I have 2 ways that you can join me in learning how to do these types of trades. One would be just if you're interested in this type of strategy, just you can get into the masterclass. Not everybody wants to sign up for a service. So if you just want to buy something, kick the tires and learn from it, learn a new strategy, learn this type of trading. It is super simple, very simple. It's just very repetitive. It's low stress. I never lose any sleep at night with this. Okay, so go to 12minutetrading.com/courses. Look for the Campaign Cash Flow Masterclass. $79 if you use this coupon code campaign79. It's a 10-module course. Anybody that knows my stuff that I put together, very, very visual, and I explain things extremely well so you understand what's going on. So that's the masterclass if you want to do that, or you can just join me if you have the mornings free, or if you just want to watch what we did in the morning on the replay, join me at the live trading room where we do a lot of different strategies. So look for the live trading room with Doc Severson at 12minutetrading.com/services. And you can get it for $147 a month, which you can pay for in no time at all, with the coupon code SAVE50, because the street price is $197 right now. So the live trading room meets every day from 9:20 to 10:05 Eastern time. We cover a variety of topics, including charting, zero DTE setups, intraday internals, more charting, and of course, campaign time spread entries. So that is who I am. That is what I do. Again, my name is Doc Severson at 12minutetrading.com. I want to thank you guys for your patience and listening to my presentation here. Let me know if you have any questions. We have a couple of minutes left. Carolyn's here, the queen of fibs. The main event has arrived. Okay, I'm looking for any questions here. You guys are welcome to reach out to me offline as well, too. If you hit me up at 12minute support at 12minutetrading.com. you can certainly ask any questions that you have. Okay, looking through, is there anything else? And I don't, okay, the 12-minute coupon code. Let's see, the masterclass, if you want to go into, let's see, I'm going to try to type it in here. $12minutetrading.com/courses. And then look for the daily cash flow campaign masterclass. And you can get that for $79 with the coupon code campaign79. There you go. Thank you, David. Okay, I think we have answered all the questions. Thank you, everybody. Thanks for your attention. And I'm happy for you guys that you're doing all this work on learning to be better traders, because you guys have looked around at the world these days. You need to be independent, and this is absolutely the best way that you can be independent. So thanks, everybody. Yeah, one time 79. One time costs for 79. Can you believe it? In today's world of inflation, only 79 bucks to learn a lifelong skill. Okay, David, I'm going to pass it back to you. Thank you very much, everybody. Appreciate it. Doc Severson out.